Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending September 8th, 2023. So let's take a look at this week's markets at the close on a Thursday. Last week was pretty much all black. This week it's mostly red. We're starting to see some doubts from investors that will have soft landing. We're starting to see inflationary fears, let's say, fueled by the price of oil, create some risk that maybe the Fed will have to hike again or keep rates higher for longer. So we're at this juncture here where we've had lots of enthusiasm through this year, mostly about the AI team rather, pushing the price of tech higher, creating some nice momentum in equities. But now this momentum seems to be fizzling and we're entering a more volatile period, which we think could last for a while. We could see some volatility in this until the end of this year, as the economy is digesting all of these rate hikes, and we're focusing on the real economic data to see how quickly this damage will be able to show up. If we will have a recession, a mild recession, a soft landing, no landing at all. So this is really the uncertain part of this cycle that we're embarking in here. But this week, higher rates. The stocks were lower, about minus 1.5 to 2%. Canadian dollar was lower, so that helped returns on foreign investments. Price of oil again, up 1.5%, closing in on $90. Price of gold lower. So yeah, lots of things for everyone here. I want to focus on the Bank of Canada in this week's review. As you've seen this week, Bank of Canada held its leading rate to 5%. So again, pause, I would say, of this year. We had a pause in June, in January. Came out of this pause in June, another hike in July, now another pause. We are of the opinion that we should be done with rate hikes. We think that there's enough evidence now to stop these rate hikes and just leave time for the economic data to tell us if that is enough, because it sure seems that the economy is slowing down enough now to impact inflationary pressures. But it's still a big question mark. It's not an easy job that central bankers have to do right now, for sure. But we had the equivalent of 19 rate hikes of 25 basis points since March of 2022. We had the 2-in-1s, 3-in-1s, 4-in-1s, but that was very steep tightening cycle. Now it's time to assess the economic damage of all of that. And the core inflation figure has made some good progress. Core inflation removes the components that are linked to food and to energy. It's slowing down. It's not slowing down fast enough for the likings of the Bank of Canada or likings, to be quite honest, but it's still slowing down, as that's the gray line is in this chart. Total inflation, which is the overall figure that we quote generally in the media, the blue line starting to perk up here. The price of gasoline, which is rebounding and should continue to rebound, looking at the price of crude oil, should bring inflation back to maybe 4.5% by the end of this year, somewhere in this vicinity. That should not push the Bank of Canada to hike again, because it's more about the domestic factors. But let's see how much this pressure could push the Bank of Canada to act. But why do we think it's not a good idea to hike some more? Well, first, the economic momentum stalled in Q2 by an interesting margin. Even the Bank of Canada's forecast was 1.7% for Q2. They put this forecast out in July, and we're talking about April to June data here, and we came out at minus 0.2. There were some one-offs, there might be some revisions there, but still it shows you that there's a loss of momentum that is consistent with monetary policy starting to bite. And as you can see in this chart here, 2 out of the last 3 quarters were actually negative for Canadian GDP growth. So we are seeing momentum stall. You are seeing the economy react to higher rates. Canada's economy is much more sensitive to interest rates because of the housing situation and also about household debt. And we're starting to see that. But population growth in Canada is so strong right now. Year over year, we're talking about 3.1% growth in population, which is something we haven't seen since the baby boom of the 1950s and 60s. When you correct for the demographic component, when you look at data per capita, you see that the Canadian economy is already, it looks like it's in a recession already. So you have two charts here. You have on the left real GDP per capita. When you look at the quantity of goods and services that are produced, so that's real GDP per capita, so you correct for the population growth, you get minus 2% year over year. So the Canadian economy is, if you ask households, and we've had some surveys this week coming out, they do feel like we're getting into a recessionary environment. So per capita, we're starting to see that. And on the right, you have the final consumption expenditure. So it's the spending from households on consumption. And here, just to illustrate the point, there are three lines. On top, you have nominal, so it's the amount of money that is spent. This is still growing, but remember, with inflation, you're paying more for the same stuff that you are buying. So when you correct for prices, you get real, which is close to zero here. And when you look at real per capita, well, you are in negative territory here. So the average household pays more for a basket of goods for consumption that is smaller than what they had before. And this is, recessions are that is the quantity of goods and services that are bought. It's not the value of these, it's the quantity. So very interesting analysis when you look at everything per capita, showing that we are already seeing the impacts of monetary policy. The big question mark here is the inflationary pressures, mostly coming from wages. That leads me to the labor market report that we had this morning. If we had a loss of jobs this morning, likely everyone will be saying, all right, so now it's time to stop. The Bank of Canada, it's done, and labor market is deteriorating. But nope, we had a surprise to the upside, created almost 40,000 jobs. That was twice what was expected. So the labor market remains strong. Hours worked remain strong. Unemployment rates going sideways. We're not creating as many jobs as there are new people joining the labor force, but still labor market remains tight. And on the right, you see that wages actually rebounded to 5% year over year. It was at 4.7% last month. And this is the thing that, let's say, hurts the prospects for rate cuts anytime soon, because the Bank of Canada has been very vocal that as long as wage growth remains between 4 and 5%, now we're at the top end of this at 5%, this is not consistent with inflation getting back in a sustainable way to 2%. So as long as we have this, we can't have inflation that goes back to target. So we have wage growth remaining sticky, even with unemployment continuing to rise a little bit. Likely, we've seen lots of new labor deals being signed recently. There's also the impact of minimum wage that could fuel, that could make, let's say, wages sticky for a good while. But this will be a big question mark going forward. We think when we look at macro data that the Bank of Canada should stay on the sidelines, but if the labor market continues to behave this way, well, we need to put some odds that this could push the Bank of Canada to hike some more. So base case scenario is that we're done, but we're worried that wage growth will force the hand of the Bank of Canada down the road to hike some more. But thinking that rate cuts are imminent, I think there's nothing here to fuel that. So what to watch next week, manufacturing sales and existing home sales in Canada. In the US, CPI inflation, which should rebound there month over month to be 0.5% and 3.6% year over year. So gasoline prices mostly fueling inflationary pressures everywhere in the second half of this year. Retail sales down, industrial production down in August. So that wraps it up for the week. ia.ca/economy. Podcast in your interest, this review, Economy Finance 101, can find it there. Social media, and follow us. And iagam.ca/insights. We just published a new monthly. The monthly macro and strategy title this time is not different, so you can find it there. You can also find some insights by our colleagues at IACAM. So thank you for following us. Always a pleasure to serve you. I'll be back again next week.